Today, we're picking stocks to add to our portfolio in 2024. And to help us, we're talking with David Dietze of Peapack Private Wealth Management. David, welcome.
Thank you for having me.
You like Exxon. How do you make the case for Exxon in that kind of environment?
We need to go to a renewable future. Where there could be an investment case with some of the legacy fossil fuel companies is if we all know we need to go to a renewable future, and we know that as we take fossil fuels out of the ground, there's little remaining, who is going to invest to ensure that before you and I go completely renewable and cut off the gas to heat our homes and switch to EV cars, who's going to produce that? Who would be silly enough to invest in the wake of public policy saying don't do it anymore because you can see we don't have snow? And so I think there's one of your case that the supply going forward is going to be reduced because there is going to be a lack of investment. And of course, many of the forecasts for when we can change over, they're kind of scary because we see the climate change, but they're saying, it's not going to be till 2030, 2035, till even half the cars on the road have switched over. And of course, here we have the luxury as one of the leading economies in the world to be able to afford that. But you got all sorts of people in the emerging markets and so forth who are just saying, I don't care what the car runs on. We don't have a car. I want something to go from town to town. So I think it's going to take a lot longer for, in some of those areas where the population is growing most rapidly, to switch to renewables. So basically, I think is going to be supply constraints, which is going to play right into the hands of the big players like Exxon, for example.
Another trend, not so great for humanity, COVID is on the rise again. What companies do you think are best positioned as a result of that? And I feel like you might say Pfizer.
Well, Pfizer in partnership with BioNTech is basically the company that saved us. Now, Moderna had a pretty good offering too in terms of vaccines. So, the good news for Pfizer was that they were Johnny on the spot. They were paid by the government. Everything went well. The bad news is, for the most part, we hope, fingers crossed, that indeed COVID-19 is disappearing. Now, there are some variants out there. So that has actually been a negative for Pfizer's business and the perception of it, because the stock was at 1.62. It got all the way down into the mid-20s because it said, that's what, propped up Pfizer. But I think Pfizer's a lot more than a one-trick COVID-19 pony. Indeed, it has worldwide operations. I think it's almost more of a pharmaceutical marketing company than a research company, because they're able to have, with the leading sales force in the world spread out all over, get whatever drugs are produced into the hands of hospitals and doctors and educate them on how they should be used. And so it's really the perfect company for smaller companies that might have a leading product but can't get it to market to partner up with. Meanwhile, of course, you got great management. You've got the chairman, Albert Bourras, who we all saw regularly in the media, was a source of reason and stability during a very treacherous time. And of course, Pfizer has about a 6% dividend. It's almost amazing that a blue chip company like Pfizer would be offering that kind of a dividend yield, which is almost 4 times what you can get on the overall market.
Speaking of dividends, I know Walgreens is on your list. They were in the news recently with a sizable dividend cut. What is the case right now for Walgreens?
When you think about it, a dividend payout from a company just goes from one pocket owned by the company that you own into your pocket. So it's kind of 6 to 1, half dozen the other. If it comes out of the company's pocket, goes in your pocket, the company no longer has it.
Yeah, you might prefer that the company be putting that money to work.
Yeah, so what I like about Walgreens is they have a lot of debt, and they're going to be able to use that dividend cut to pay down that debt, which is going to give them a firmer footing there. They're also going heavily into primary care. They've got these stores. Indeed, there's 3,000 stores across America. I think 80% of the American population lives within 5 miles. So they're there already, which is worth a whole lot. And they're going to bring in primary care physicians into these various pharmacies so that it's going to be a one-stop shop. Get your basic diagnosis, get whatever you need to treat it, and Walgreens will do well with that. They've also made a big purchase out where you're originally from, perhaps, and I live, Summit Health, which is based out in New Jersey and so forth. Huge company, was owned by private equity, now is owned by Walgreens. And so they're getting additional exposure that way. The other thing is they made an acquisition that was kind of ill-timed. Boots over based in England, pharmaceutical company, drugstore company, and they may want to ultimately unload that. It has not lived up to forecasts and so forth, and that would also put them on a more secure footing. Remember, they cut the dividend, but still 3.9%, which is almost 3 times what you can get in the S&P 500. So it's still very generous. Number 6 in the Dow. There's the dogs of the Dow. The top 10 dividend payers on the Dow tend to outperform. So those are some of the reasons we like Walgreens.
Thank you, David, and thanks for watching. For more coverage of business news, check out QZ.com.